This is going to be an update video on my TFSA account, the dividend portfolio that I started back in February. So this is just a bit of an update. So the markets have been in a downtrend recently. September has not been a kind month to stocks. So as you can see here, like in my TFSA for the last day, we're down 1%, which is on negative 62. Previous week we're down 89, which is 1%, and for the month we're down 2%. 3 months we're up 1% overall, $98, and all time we're up 481.99. This used to be like 10-11%, but again, the market pulling back is something that we can't control, and there are reasons for it that I'm going to get into later in the video, but I'm just going to show the portfolio right now. So we have $58 in the cash account. I recently bought a bit more Apple just because it's been dropping, and if this continues to drop, I'm definitely going to continue adding into Apple. You can see that some of our positions are down, like AQN, Kushtar, Baba's down just because of the Evergrande crisis situation in China, so there's a lot of economic uncertainty, and whenever that happens, people definitely start to sell out of stocks. So it's a normal thing for the market to go down sometimes, and it's not going to be in your control. But depending on what you're invested in, as long as you know the companies that you're invested in, you should have nothing to worry about. I mean, if you are just hearing about stocks that people are just talking about, or you're just seeing hyped on YouTube and you really have no idea what those stocks do, then yeah, you should definitely be scared because you have no clue what you're invested in, and if you don't know why you bought a stock, you will never know why to sell a stock or when to sell a stock, or if you even should. So that's definitely the biggest mistake one person could do. So I would say don't be scared of this dip. I'd say just make a list of your top rated stocks and just watch them. And if they fall, definitely focus on acquiring as many shares of those stocks as you can. So like Apple would probably be top of my list. And I know Microsoft in my watch list also dropped immensely, so it was trading over 305, now it's 283. I'm definitely going to watch this one. If it falls to my target of 250, I'll probably throw in a fractional trade into that and just start a position. So we really just bought one more share of Power Corp recently, just because it was going ex-dividend on September 29th. So essentially, I bought it on September 28th. You have to buy a stock 1 day before the ex-dividend date to get the dividend for the upcoming period. So they're going to be paying the dividend on November 1st. And I do like the price. I like the company. They pretty much own a large stake of Wealthsimple, so that's one of the main reasons why I own this holdings company that owns many, many financial businesses and wealth management services. And we also are going to buy another share of Intel. I just don't have enough in the cash account right now to purchase another share. Especially, I'm going to watch for this one to drop as well. Just because we started the position, it's less than 1% of the portfolio. I definitely want to increase that position as soon as I can, just because 1% of portfolio isn't really, that's not where I want the allocation to be. So we're just going to keep buying more shares of Intel until it's 3 to 5% of my portfolio. But we'll definitely watch the rest of the market as well, just to see if there's any more opportunities that come up. Here are the reasons why the market is suddenly in a sell-off and dropping. So in the States, they're going to have a meeting in Congress to raise their debt limit. So that's basically like, you can think of it like raising your credit limit on a credit card, but in this case, it's for the whole U.S. economy. And the uncertainty would be that if they don't raise it, they would have to increase interest rates, which is very bad usually for the stock market and certain businesses that have really high levels of debt. So you can think of, REITs or just retail businesses that have tons of debt because they have a lot of capital expenditures. They have to have higher debt load. So A higher interest rate is definitely going to impact not only businesses but individuals as well. And it also said interest rates on mortgages, cars, and credit cards would also go up. That will generally hurt the market and the stock market. And the stock market generally works and feeds off of sentiment. So if people feel that the stock market's going to decline, people generally sell out of it, and then it just turns into a self-fulfilling prophecy of people selling. And it works the opposite. When people feel good about the economy, they feel good about the market, they generally drive the price of stocks up, and you're not really seeing volatility. You're just seeing a steady increase in every stock across the board, which just is not sustainable over long periods of time, just because businesses don't constantly go up in a straight line. It's always going to be, good periods and bad periods, but generally trending upwards over a long enough time period. And as for what you should do during this market downturn, I would say just be consistently invested in the market. So this is going to be a chart following the S&P over a long period of time from the 80s all the way up to now. And you can see the blue line is going to be you buying essentially the downturns of the S&P. So you're going to be a perfect market timer, and you're going to see that it actually underperforms dollar cost averaging, which is buying consistently every week, every month, whatever it may be, when the market is high, when the market is low, just because the longer you remain invested, the more time your money has to compound your dividend payments, and you can get a higher return overall and not really worry about timing it perfectly. The longer your investment horizon, the less and less it matters when you purchase your shares. You really have no control. You don't know if the market's going to go up and double in the next year. You don't know if it's going to keep declining. The best course of action is to just remain invested for long periods of time. People just get really hurt when they invest in the market for a few years, and the results vary, right? You could make a ton of money in a few years. You could be down a ton of money. But the main thing is, if you need money in the next 5 years or something, I don't think you should be investing that money. It really should be money that essentially doesn't exist. You need to have your savings account set up, your emergency fund. You need to have access to other sources of money, not have your entire net worth in stocks, because when there is a downturn, you will be, and you fall into hard times, you're going to be tempted to sell your portfolio at a loss. So I guess that's one reason why getting dividend paying stocks is definitely a nice psychological advantage, is just because even in a downturn, you're still being paid from your companies, from your holdings, and you can take those dividend payments out of your account and help you in the moment to pay a bill or whatever else you need money for in your life. So that's why I choose it as my strategy. And I am very comfortable with the market declining going forward, just because the less I pay for my shares, the higher my return will be in the future. So essentially, the market declining is better for me because I get more shares of companies I like, and I get more dividend payments, essentially. So just more interest. So I welcome the market downturn, and I hope it continues for years and years, because my investment time horizon is going to be at least 10 years minimum before I would ever consider touching my investing account. So definitely keep that in mind, and just have a more longer term focus, because even the media is going to be all negative about the markets going forward, and they're really just concerned about the next 12 months. They're not thinking about the next 12 years. So don't think about the next 12 months. Just always be investing, because there's countless studies showing that just being invested for long periods of time will generally yield you good results. If you invest for short periods of time, it's kind of a question mark. You could be down a significant amount if you're just investing for 2-3 years. And don't forget to like and subscribe to the channel. And please leave a comment if you enjoyed the video or you have any questions. And if you want to get started on your investing journey as well, Wealthsimple Trade is offering a 2 free stocks currently. So if you sign up using the link in the description and you open a personal account, so a non-registered account, and you deposit, I believe it's just $1, Wealthsimple is going to give you the value of 2 stocks. So and the value can range from $5 to $4,500. So essentially, they're just giving a lot of money away, and they are a great brokerage. They offer fractionals, and they're adding to that list all the time, and it's just a great brokerage to use, and I can only see this one improving over time because they've just been adding features since I've started. All right, have a good day.